The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN just after 9 a.m. Eastern Time, Thursday morning. We got another wild day in the markets in store for us. It's quite a week, folks. We got going in this market. Is today the day we get a little bit of calm? Well, overnight, not quite the case. We were positive. You check out the S&Ps yesterday, right? You get the huge acceleration yesterday in the news. The Credit Suisse, they're going to have a backstop from their national bank. That's a big deal, man, getting that backstop. Credit Suisse, they're not going to go under in any dramatic fashion as they do have a backstop from their central bank. That puts a bit on the market, but guess what? We just kind of gave all that back up. We have initial jobless claims this morning, back under 200,000. Inflation is still persistent. We have the ECB with their press conference, with their hikes coming up, and that could provide a little bit of volatility, and that's all ahead of, folks. Don't forget, we have a Federal Reserve meeting 6 days from now, March 22nd, man. We get to find out what's happening here. We get to digest it all this morning, and we kick things off, and you see the rollover. S&P's 39.10. We're above 39.40 for most of last night on that optimism for Credit Suisse. And yeah, Credit Suisse, they're back above $2, I think, this morning. But guess what, man? The pain is not over here. We got First Republic back to almost lows. Yeah, so the pain is not over just yet. NASDAQ 100, you're up by 6 points. You check out the action. NASDAQ in the positive. Dow, negative by 112 right now. The Russell persisting, man, down 1% right now, right? You look at that divergence in terms of the Russell just getting hammered recently. NASDAQ 100 is positive for the day. Russell, negative by a full percent right now. Bitcoin, sitting pretty comfortably at about 25,000 for Bitcoin right now. You got crude. All the talk, man, down to 65 yesterday. We're trading at 67.15, and boy, that's a decisive break, folks. You take a look at this crude contract, you put it back. That's a daily. Let's put it on a weekly. It'll be a little bit clearer to see. And yeah, you look at this area, it just broke through, man. Number one, that was the area that had basically been support since November. Folks, it's March. Okay, that had been support since November. It had been supported around $72. Okay, right at that price point right there, 73 maybe. You talk about a decisive break down to 67. You're pushing into the lows that we saw of November of 2021. That low is 62.43. We were just at $65, man. 62.43 was the low of November. August, 61.74. So you're talking about $62. We were just at 65. No reason why we don't make it down to that price level for the price of crude. And gold, catching a bid. Gold up another $3 this morning, back to a 15-minute chart. Charges to 1942 yesterday. You drop off a bit last night, but we get it all back. The market's deteriorating a bit as we come into the opening bell in about 21 minutes. You got to jump to notes and bonds. And boy, we're pushing highs, man. It has been a week like I've never seen, folks, in notes and bonds. You put things back to a daily. We've been talking about this trend line. We were talking about how it was an important area, right, where we're going to see this reject that trend line and trade lower, back within the channel, or were we going to see it test that channel line and bounce higher, indicating lower rates? Well, boom, banking crisis comes at you, man. The market, yeah, there has been a flock to safety, folks, and it is interesting to see whether the Fed is going to let this dictate what they do, because it's not going to dictate inflation, folks, okay? It is going to be a factor of inflation, but it's not going to dictate inflation. So I find it so remarkable that we have the ability. I mean, it was a week ago, folks, that we had the chairman in front of Congress, right? To put things in context, time has moved so quickly. We'll back this up on a 20-day hourly. Yeah, I had to check myself and make sure it was just last week. I was like, is that 2 weeks ago? Was that 2 weeks? No, it was last week, folks. The Chairman Powell was in front of Congress last Tuesday, okay, 9 days ago, talking about rates are going to be higher for longer. On Wednesday, he pared it back a bit when he went in front of, the House or the Senate? He went in front of the Senate. No, the House first, I think. Wherever he went, I think he went in front of the Senate first, right? And then he went for the House the second day. And then the banking crisis started on Thursday. Okay? So it's only been 1 week removed where we were all the talk. And yes, a banking crisis is going to tighten things up. There's going to be less loans out there. There's going to be less liquidity. It's going to be a factor. But look at initial jobless claims, man. Look at the numbers coming up. It is going to be a factor. But, boy, that is not going to tame inflation. And the Fed is in a very difficult spot right now. Headlines are everywhere in terms of the ECB talking about maybe some troubles with some of their banks over in Europe with potentially exposure to what was going on with Credit Suisse, et cetera. And there's the headline. So Credit Suisse seeks circuit breaker with a $54 billion line. The Swiss government holding a special session on the bank crisis. And $54 billion credit line with the country's central bank and offering to buy back debt as executives and government officials plot the next step. This is just the first step. That's the next step. Surge as much as 40% before pairing the gains. And so they're up a bit. It's quite a backstop. My dad was talking about it last night. I was talking to him this morning. We were FaceTiming with Tommy. So we do a little FaceTime in the morning. We chat a little market in the morning, right? You got to on days like today, weeks like this. And on his show yesterday, he was talking about, folks, if you didn't get a chance to listen to it, my dad's program at 3 o'clock, saying, this is the cycle, right? This is what the Fed does. They stimulate the economy until it gets a little hot, and then they pull the economy back, and they deflate the bubble, and then they do it again. And the only thing that's changing is how much time is in between. When we were chatting this morning, we do have bubbles, right? But their job is to make sure those bubbles are not as big when they burst, right? They're to alleviate the rise and fall of some of the natural forces in the market. I said, could you imagine what would have been going on if there's no regulation in this market? This is when there's regulation and they're only allowed to buy government securities. Could you imagine if they were allowed to have anything on their books that actually had credit risk versus just rate risk on the bank's books? This is where, folks, you got to clue in. Regulation always gets a bad rap because everybody wants freedom and to be less regulated until those regulations are needed, okay? Because you see the potential, times are good, people become over-leveraged, and even when you can only do it in government securities, man, they figure out a way to lock themselves into a trade that costs them tens of billions of dollars. And then they don't have the money when everybody wants it back. And that's just talking about buying treasuries. And, my dad was talking about, rightfully so, the last thing you want is your banking system shying away from buying probably the safest investment out there in terms of credit quality. Think about that, right? So they almost had to step in this instance, because if you create an environment that banks are going to be penalized for buying the most highest credit quality securities, it goes both ways, man, because they bought them at 1.63% to the tune of $90 billion, right? That's not really forward thinking in terms of the risk you had for rates rising at a time that some of that was there. And they could have protected themselves as well. But the point being, folks, the bank has stepped in over in Switzerland, and the bank has stepped in here, the central bank. And they're not going to let that banking system fail. And they're going to be helped out by the fact that the problem on their books is the rate risk of those instruments. And all the Fed needs to do is take them at face value, hold them for long enough, and they will get the capital back. And with this contagion spreading, that is an option that they've already taken advantage of, and they're going to persist on that one. So what's going to happen? It's not going to be that dire where it's going to tame inflation. So inflation is going to persist, man. How about the real estate stocks, right? We got a lot to talk about today, man. How about Lennar yesterday on their numbers trading higher? You take a look at this stock, man. The writing is on the wall that inflation is here, folks. Stay tuned. We'll be right back. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. So I believe the ECB just went 50 basis points. Great discussions going on in the Tiger's Den this morning, as usual. You see a little bit of volatility on that news right now this morning, with the S&Ps now down 18 points, just spiked below 50, below 3,900, not below 50 basis points, below 3,900 in the S&Ps on that number. And yeah, so, you know, you're talking about Europe before, of course, the health of their banks. I'm sure Christine Lagarde has a good idea in terms of how their banks are right now and the ability for them to handle another 50 basis points. They go 50. Don't think that she has not been in contact with Mr. Jerome Powell in terms of where they will be going. And maybe you're seeing the impact this morning. It says, man, they go 50, and they were supposed to go 50. Okay, that was the indication before this started, the bank deal. But guess what? Maybe that means that, yeah, what's Mr. Powell going to do 6 days from right now? Right? Are we going to be seen as the one with a weak banking system that now can't keep up with inflation? I'm not so sure of that, man. They're probably going to go 25. But boy, it's an interesting time to be alive and in the market, man, because there is volatility everywhere, and we're going to see how it plays out, to say the least. And so we jump over to Lennar, right? Just trying to think big picture on this. And we're going to back things up a little bit. We'll go to the 3-year weekly right now. So check out Lennar, right? Now I'm going to take this Fibonacci off because we basically rose almost to a complete level of the high. Duplicate, no. Remove. So what's so interesting here is you go back to last year. Oh, I apologize. Of course we do. We got our man Kevin Hincks on the line. Kevin, let's just jump into it, man. We got a lot of action this morning. We got the S&Ps down 22, the whole saga with Credit Suisse going on, and we have an ECB meeting. Good morning, Kevin.
Good morning, Tommy O'Brien. Yeah, I mean, breaking right now with Christine Lagarde, the ECB raised interest rates by 50 basis points. Now, Tommy, remember, in early February, she said she's going to do that, right? Going to go 50 basis points to 3.5%. But, Tommy, this is the first discussion because of the Fed quiet period that we've heard from many of the central bankers. And you're right, Tommy, what you said. You know they're in touch with Jerome Powell. So this may be the first indicator for what our Fed is going to do on the 22nd. So, yeah, you're right. Things are getting pretty interesting here, Tommy, as we get through.
Yeah, pretty remarkable. The market's reacting as you're talking, Kevin. We get the S&Ps down about 25. It looks like the market kind of having the same discussion that we're having this morning. As a trader, Kevin, with the market sitting at 3,900, this is the first glimpse, as you said, we're getting. They go 50 basis points. You must be pretty confident, as we talked about. Where do you see the market going and the $1 million question, the $1 billion question? But is there some calmness? Looks like, our banking sector is not going to collapse. Looks like the ECB must be okay with their banking sector if they're going by 50. Quite a market. I'm trying to just do it in my own head, Kevin. We get a Fed meeting in 6 days from right now. We're sitting at 3,900. Is the market going to try and figure out what's happening all about that Fed meeting as we digest? I mean, we got initial jobless claims this morning, but it's kind of just wait and see with where the Fed goes, I think, in 6 days, which is, man, a long time in this market right now.
Yeah, with a 10-year yield now approaching 3.4%, Tommy, things are certainly getting interesting. And what did that lead to? The yields coming down, strong, strong data out of mortgage apps on yesterday. Really strong data from housing starts and permits this morning. So housing coming back because rates have come down. So I think that part is interesting. You're right. The jobless claims data was strong. So this is still, Tommy, what happened this past week with SVB, make no mistake, that's their fault. It's not the Fed's fault. It's their fault. They mismanaged their risk. And so to blame it on anybody other than their management is not seeing it the way it is. They had every chance to hedge their risk, and they chose not to. Why did they choose not to? Because it hurts profits to hedge risk, right? But that being said, now that's taken care of in some way. You've got pretty calm headlines overnight with Credit Suisse now getting their loan. I think this is going to be really interesting how this plays out in the next couple of days.
You make some great points, man. And, hindsight always is 20/20, folks. But this one, if you're in the market, if you saw the yields, I mean, Kevin, I was having discussions even with friends. My mom is retired. She's still relatively young, in her young 60s to be retired. And you're thinking about yields. And we had these conversations when yields were so low. And, you can have a good portion of your retirement portfolio, folks, in fixed income. But it was so hard at that interest rate, Kevin, to really be a proponent of that, because even at a young age, folks, if you're going to need that money, you're putting a lot of risk on the plate for a yield of 1 to 1.5% at those lows. That I really wasn't a fan of that and really didn't allow that, not allow, but I wasn't really a proponent of it for her, Kevin. And I find it so interesting that I can't even profess fixed income to my retired mom. And meanwhile, here's a bank parking $90 billion at 1.6%, not able to figure out the same thing I'm thinking about that says, hey, what if you want that money in a couple of years and rates are higher? Pretty amazing, man. Hey, I want to jump to Apple and Amazon and some of the other equities that have fared pretty well with some of the turmoil going on. I got Apple up here. You have some volatility, of course. But in light of what's happened with the market, Kevin, some of these equities, Apple in particular, they were a safe haven on some tough days. What do you think of some of these equities, man? In crisis is opportunity, and kind of we're seeing different equities really behaving different as we approach probably a different part of this market that's going to drive where we go going forward now with this weight of higher interest rates on the financial sector.
Yeah, I think what's going on with the NASDAQ being the strongest market. Remember, the NASDAQ spent most of overnight and this morning higher, and it's down the least of all the four major indices. It's down. It's only down. What's that? Probably 1/3%, maybe something like that. But Tommy, I think the NASDAQ is where people are going. You've got good news out of Meta again today. With remember, if the U.S. government bans TikTok, that's really good for Meta, and really good because of their Reels is their direct contributor, and people will flow there for sure. So that's good news. You've got Snap up on that, and you've got Meta up on that. Not a lot, but the UK just banned TikTok on their government devices, so the trend is certainly flowing that way.
It's pretty cool, man, in terms of who was the leaders, who was the pullback, and I think you're seeing some rotation there, to put it lightly. With that in mind, Kevin, it's quite a market, it's quite a morning. What are you guys talking about on Fast Market coming up at 12 today?
FedEx earnings after the bell today, so our focus will be all on delivery. We'll trade FedEx, we'll trade Amazon, we'll trade UPS today.
Ah, nice. Quite a lineup. FedEx, Amazon, UPS, you heard it, folks, and I imagine they'll have some discussion of the ECB, of our man Jerome Powell, and everything going on in these markets. Kevin, I appreciate it on a busy morning, a busy week as always, man. We'll be watching at 12 o'clock today, and as I always say on Thursday, man, boy, a week ago when I talked to you on Thursday, Kevin, the world changed by the time I talked to you on Tuesday. I look forward to the show at 12, and we'll talk to you next Tuesday, man. And who knows where we're going to be in this market. As Tuesday, that's going to be when the Fed already starts meeting, Kevin. Pretty wild how quickly these data points are going to be coming at us. I appreciate it, man. We'll be watching at 12. Have a great one, Kevin.
Buckle up, Tommy. Talk soon.
That's right. Buckle up, folks. And you know what helps you buckle up sometimes? Defined risk, folks. Please check out Fast Market. Great name for the program, and it's a fast market, folks. And we're going to see one this morning. Defined risk, right? Make sure you're trying to define your risk. Define your risk in this market, man, because we're seeing you wake up one day, you don't know what's going to happen, folks. Some of those risks, they're outliers. Doesn't mean they can't happen, so protect yourself. S&P's off 23. We're coming back for the opening bell. Stay tuned, folks. We'll be right back.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, Butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. You got the S&P down about 20 points, trading at 39.04 right now. NASDAQ barely in the red. You're down by 1/10, 2/10%. And let's go a little big picture, okay? Now, what's so remarkable, folks, is you go back to a big picture on the NASDAQ 100, right? We've been talking about this prior, okay? And Kevin was making some great points. I was asking him, you're seeing a rotation, man, and you're seeing the Russell getting slammed, okay? 1.3% to the negative. You're seeing the NASDAQ only down 22 points, 0.2%, the Dow off 0.6%, and the S&P off 0.6. So again, S&P and Dow off 0.6%, NASDAQ 100 only off 0.2%, and the Russell right now off 1.5%. It's been the theme lately. Now, you check out the big picture. Big picture, NASDAQ 100 goes from a price point, absolutely remarkable, 66.28. You trade up 10,100 points from the COVID lows to the highs of late 2021. NASDAQ 100 gets to a 618 retracement by October of last year. You got basically almost to that price point in June. It was a one-way trip right away, man. Absolutely remarkable. You go from 16.7 down to almost 11,000 by the middle of the year. Point being, you got to a 618 pretty quickly. Now, what I've been talking about is that, folks, the the S&P 618, I think is totally in play, man. Doesn't mean it's going to happen, folks, and no one can tell you for sure what's going to happen, okay? I think the best way to think about things, and I've talked about this before, is you want to think about the buckets of things that can happen, and then you want to price the probability of those events occurring, okay? So what is the probability the market stays where it is? What's the probability it goes down 10% this year, right? What's the probability it goes up 10% this year? What's the probability you pull back to 3,200 this year, right? That probability is greater than zero. Now, maybe you think it's zero, and maybe you make a trade on that, and if you're correct, you get paid appropriately for that. I think the probability that the market has a chance to go back to 3,200 is probably greater than zero and greater than most people anticipate at the same time. And the interesting thing about this is the 618 is where it would go. And it would go basically to the lows that we had in October of 2020, when everybody was happy as a clam that the S&Ps were sitting at 3,200 after trading at 2,100 at the depths of COVID. It would bring you back to basically prior to COVID, and it would bring you back to a 618, which is what the NASDAQ 100 did, okay? Now, it was always interesting to think, okay, does that mean the NASDAQ 100 is going to pull back? So I don't know. That really wasn't the case, okay? It was going to be interesting to see if, guess what? When I was thinking about this big picture, I was saying to myself, okay, how's this going to happen, right, if this plays out fundamentally? Because the charts are maybe saying that the S&P could do exactly what the NASDAQ did. But how's that going to play out when all the talk is about interest rates, growth stocks are getting pummeled, right? Well, in my head, I was saying, well, you know what? I mean, we've talked about Morgan Stanley's Mike Wilson many times in his takes. And I think one of the things that he said that makes sense is, you know, you're going to go, and this was prior to the whole banking crisis, it was that, you know, you're going to go from this rate risk, okay, for growth stocks getting punished, to eventually we're going to be able to pause. Maybe that's under control. And then what are you going to see? You're going to see all this talk of recession. You're going to see margins getting crushed in the later part of this year. And what's that going to do? That's actually going to hurt companies with earnings and small margins. Some of the growth companies have huge margins, okay? So the rate worry was going to be over, and it was actually going to come for the time for those companies like dividend stocks, right? The S&P 500. Now, the tech stocks are still big in there, but it was going to hurt the earnings of maybe dividend stocks or just not growth stocks in general, right? And that was going to weigh on them. So growth stocks were going to get hammered in the beginning of the run, which happened at the beginning of last year. And now we are transitioning potentially to the area of the economy that is going to be a worry for stocks beyond growth stocks, as in just hitting the economy. S&P 500, economy-wide, recession looming, right? Maybe that hits the S&P a little bit harder than growth stocks if actually you might see cuts coming down the line because the recession is so bad. It's kind of what's playing out to a certain degree, right? You're seeing regional banks get clobbered. That's you know, the banking index is one of the most reliable indexes you could see, a regulated index, FDIC insured, dividend stocks in there, et cetera, right? No, not the case. So keep that in mind, man. There's your NASDAQ 100. It did it in no time. The S&P could do it as well. And it even goes beyond that with some ABC numbers that bring you pretty close to where we're talking about. I've done it a couple times to do it on the fly. What is it? Was that bring it down? It's about 1,000 points. Yeah, I mean, just look, they're everywhere, man. You know, your first run in this S&Ps was 1,000 points, 4,600 down to 3,600. You traded up to 4,300. Well, 1,000 points from there would bring you right down to where? About 3,300. Okay. Well, it didn't do that. It traded down 800 points to 3,500, but you got an 800 point leg from 4,300 to 3,500. And then what'd you do? We've chopped around between about 4,000, 4,100. Well, you take 800 points off there, you're close to 3,300, 3,400. I mean, I'll cover it again, folks, but just put it on your radar that it's possible. And if you're not comfortable with that type of action, I advise you not to be in the market overloaded, because we have some volatility coming down the line, man. And I think you saw a glimpse of what was happening with the ECB, and that's what has the market a little bit worried this morning. And that's not even to talk about that the Fed is going to be in a tough spot. I imagine they're still going to hike, especially with the ECB going 50 basis points, okay? And let's jump over to some of the currencies this morning as we do. They hiked 50 basis points, folks, and you still have the euro at basically the lows of yesterday, right? Quite a sell-off on the euro yesterday. You jump over to the dollar. Dollar strength yesterday, and we're actually trading a little bit higher today, and that might mean that the market's figuring out pretty quickly, hey, ECB went 50, man. Fed ain't pausing, okay? If ECB goes 50, and they're so confident that they need to tame inflation and they don't need to worry about the banking crisis that's potentially reverberating around Europe as well, then yeah, the Fed is going to go 25 at the same time, because that means that they're confident. It probably means the backstop that we have going on is there so that they can kind of fence off that risk of contagion so that they can still apply the pressure of rate hikes, and we'll see where we go from there. But jumping back to Lennar, to put it in full circle, okay? Excuse me. So what happens with Lennar? They dive lower on rates, but then what happens? Well, what happens, folks, is, inflation is going to persist. And if inflation is going to persist, houses are going to persist, and the numbers are pretty decent, man. And we got housing numbers, okay, to jump over, to tie it all down. Housing starts exceed forecast on multifamily construction, rose almost 10% to 1.45 million pace. Completions in February climbed to the highest since 2007. New U.S. home construction increased in February for the first time in 6 months. A surge in starts of multifamily projects. Housing market may be starting to stabilize. Pretty wild, right? And that would make the case that, guess what? Fed's in a hard spot. They're going to continue. But boy, the writing on the wall is it's not going to be as easy as we thought. We don't have the strength we had at the beginning of this hiking cycle. The strains are now becoming obvious, and the market is going to be in a tough spot. But watch out for those real estate stocks trading higher potentially, folks. And boy, you ever start getting to the pause that, I don't know where we go. We get to find out in 6 days from right now, but I imagine the writing's on the wall for at least a 25 basis point hike with the ECB going 50. And yeah, but pay attention to those, man, because Lennar almost pushing the highs it had last year, up another 1.5% today, even after yesterday's gain as well. Stay tuned, folks. We'll be coming back right after the break.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foresight Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We get the markets trading a little higher. S&P is only negative by about 13 right now, trading at 39.10. But boy, as Mr. Kevin Hincks said, buckle up, folks, because we just seen moves in both directions in this market, and it's not over yet, man. If you thought the banking crisis was completely done, then just look at the volatility you're getting in First Republic. Down 31% today. You're almost pushing lows. What happened to the move from 17 up to 50 on Tuesday, at 30 yesterday, at 21 today? Be careful catching any of these, folks. Let's see how. Yeah, Pac West down another 13% today. Be careful for some of those smaller banks that really are in a jam there. We jump to some of the bigger banks. JP Morgan off 0.7. It's almost pushing the lows of yesterday. Bank of America down about 0.3 right now. I saw a story out, Bank of America collecting $15 billion in deposits. Not surprising, as of course you're seeing a run on some of those smaller banks. There's no reason to keep your money in them, folks. If you're just parking it there for no reason, why are you doing it, right? And that's the problem with what's going on right now in terms of what is playing out. Now, we jump over to some of the other data this morning. Weekly jobless claims. Initial unemployment claims decreased by 20,000 to 192,000 in the week ended March 11th. The media estimate was looking for 205. Now, what's even more interesting, in my opinion, is that continuing claims also fell. That's not what's supposed to be happening right now with inflation where it is, man. Continuing claims falling by almost 30,000 to 1.68 million. That data 1 week delayed versus the initial number. That data for continuing claims is March 4th. The initial claims data is the week ended March 11th. Economists watch this measure closely to discern how hard it is for people to find work after losing a job, obviously. On an unadjusted basis, claims fell to 217 as New York unwound most of its jump from the prior week, which could have been due to school holidays. What's so interesting, and we're getting lessons everywhere because the data is so important right now that I think we're all much more in tune with that data and understanding it and understanding the nuances and how data is adjusted, non-adjusted, etc. One of the things that did happen last week, which was one of the reasons why they said you could have seen a rise last week in particular, is that you had holidays where people can actually claim unemployment when they have holidays. Something to that degree, which I found remarkable, but that was one of the reasons why they thought last week could have been a little hot, and it seems like maybe that could be, as New York unwound some of that number from prior. And in that period, applications also surged in California, where you have had some weather playing out. Strong numbers, man. You take that with an ECB hike. Now you jump over to the headline. European Central Bank, ECB rates, hikes rates despite market mayhem, pledges support if needed. And the quote is pretty clear, man. Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the three key ECB rates by 50 basis points. That brings them to 3% now. They were in negative territory when they started their acceleration last year. And yeah, they of course are monitoring what is happening. And we'll see where it plays out. But that is going to be a factor. And the market taking it in stride so far. Because if you recall, folks, you don't have to recall far. You have to go back a day or two. That's basically it. Who was it? Nomura was calling for a cut. There were a couple other people calling for a cut, right? A pause, a cut, the end of quantitative tightening, QT. That's not happening. Okay, the ECB is not hiking by 50 basis points while we're cutting. Meanwhile, our inflation is still where it is. Not happening. Okay, anything's possible in 6 days, as we know. But I don't see how that's even possible with the way the ECB comes out, because you got to think of how things matter and look at the dollar, okay? Because this is what matters in terms of the dollar yields. But look at the dollar acceleration on strength yesterday. We're holding up today at a time when the ECB is hiking by 50 basis points. If the market thought that the ECB was going to continue aggressive pressure and hiking to the tune of 50 basis points at the same time that the U.S. was going to be hampered by a banking crisis and potentially need to pause or cut, you would see a dramatic difference going on with the dollar and the euro. You're not seeing it. And so we'll see where that plays out in the longer term. But boy, absolutely remarkable. At the same time, you get dollar strength, right? We got yields pushing the lowest levels that we have seen. And boy, this is what is screaming. Volatility is here for a little while, to put it lightly, I think. Let's jump over to the VIX on volatility. Volatility index still sitting at about 27. Yeah. And yeah, Kevin was talking about Meta, man. There's Meta. They give back the gain they had from 204. You're up 0.3% at 198. And yeah, I think that there's two things that are going to happen. You're seeing a lot of talk about it, and it's probably because it was laid out. They're either going to get banned in the U.S. or somehow, and this is what I don't understand, and I don't understand why China would even allow it, right? As in, TikTok is owned by ByteDance, right? And ByteDance, their parent company, is owned by China, or is it ByteDance? Either way, they're going to divest or you know, take themselves out of Chinese ownership in some capacity. I don't understand why China would ever allow that, number one. And that speaks to the real motive behind China owning that, which is they want all the data. Why would China ever give that up? They don't care about the money that they're going to get from divesting in TikTok, man. That is a once-in-a-generation opportunity to control the social media apparatus that every single young person in the whole world is using and get all that data. I just don't see how China gives that up. So if China doesn't give that up, then I don't see how they don't get banned, because they really should be, man. That's one of the few things I do not have on my phone. I downloaded it once. Maybe they got all the data they needed from me then, but I felt a little too dirty having the Chinese dictatorship in my phone, tracking me everywhere I went and knowing everything. I just didn't want it to happen. You know, you draw a line, folks. We draw a line. Everybody has their line where they're comfortable. You know, the tech companies know all about me in terms of what I do, where I go, et cetera, on my phone, but there's a difference with allowing a for-profit company to do that versus allowing the Chinese government to do that. And so that's where I think that difference lines up. And yeah, now it'd be remarkable if somehow they can facilitate that they're able to get TikTok out of Chinese hands. That would be the only way that happens. And that's a little bit of a risk here. If you see that headline come out, you're going to see these stocks recoil, because yeah, I haven't used TikTok, man. But I do tell you that the only thing I enjoy Instagram. And that's because I see pictures, you know, I don't want it seems like Facebook is just garbage, man. And they're very fortunate that they own Instagram. But in general, they're facing some heat, and I don't see how it's a tough business plan, let's put it this way, when the greatest success that your stock can have is when they just make your competitors' actions be illegal or the company be illegal. That's a dicey one in terms of really believing in that one, but guess what? That may be what's happening, and if they don't somehow break away from the Chinese control and ownership, that's probably is what's going to happen. So that's where you have to decide what the probability is that they are able to break away from Chinese ownership. Because as long as China owns that data, man, in any capacity, if they own that company, you know they're going to get the data. No matter what they do, no matter where they set it up, that's not going to fly. Yeah. All right, S&P's down by 17. Trading at about 39.08 right now. We'll take a look at some Fibonacci numbers when we get back, folks. Let's check out the gold contract as we come into this final break. Gold contract right now, Yeah, pushing recent highs. We're up to 1940, almost, right? What we're trading at. These are 15-minute bars, 1938 on that gold contract. We're up by, we're basically flat on the session now at 1931. S&P's off by 19. Stay tuned, folks. We'll come back, take a look at some of the other equities moving this morning. We'll be right back.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding the reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got the S&Ps off 15 points right now. We have the NASDAQ 100 almost flat right now, trading, we'll call it flat, off less than 1 point. It just goes green as we speak. The Dow off 200, the Russell off by 17. I was reading an article from the Journal out there talking about how SVB, Silicon Valley Bank, went to Goldman Sachs to try and get out of Dodge in February. It didn't exactly work, to put it lightly. But they put it lightly in the most simple terms, folks. And this is where, the discussion in the den and, blaming Chairman Powell for hiking interest rates, folks, the banking industry is pretty simple in terms of you take money from some people and you got to use that money to make more money than you're paying those people to borrow it, right? Well, if you take a bunch of money from depositors and you lock in a 1 to 1.5% yield for that money, what are you going to make money on if those people actually demand more than a 1% yield on the money that you're using as a bank for them? And that's what happened, man. You know, they basically had all this money, and they talk about it. So Goldman, so they talk about all of it, and they just put it in the simplest terms, right? In terms of banks make profits by earning more from putting money to work than they pay depositors to keep it with them. But Silicon Valley Bank was paying up depositors from leaving, and it was stuck earning a pittance on low-risk bonds bought in a low-rate environment. So, you know, you can blame it on a number of things, folks, but this is a bank that decided to put all their depositor money in long-term debt that was giving them 1.5% almost. And when it came time that people that had deposited money with them wanted more than 1 to 1.5% to park it at that bank, the bank was in trouble, and they didn't see it happening. And yeah, all they had to do was hedge. Okay, that's it. Everybody said, they did this, they did that. You could have done this with the hedge, and many banks would, and you probably should have done it if you parked $90 billion in there when you saw a deposit surplus that no bank had ever seen almost, in terms of would they go from $60 billion to $200 billion, pre-pandemic, post-pandemic. I wonder how long it's taken a $60 billion bank to get to $200 billion before. Probably was a record. Yeah, hindsight, man, hindsight. They're a bank, folks. They're a bank dealing with interest rates. Thanks for starting your day off with me, folks. Stay tuned. Basil's up next. It's going to be a wild one in the market. NASDAQ 100 up by 20 already.